the entire world runs on debt. Like that is, debt markets, are 1,000 times bigger than equity markets. The entire world runs on debt, except for Silicon Valley. We have no idea what to do with debt. We don't know how to loan against, stock. We don't have to give loans to startups. Like none of it. It's all equity based. And the reason why is that in order to give somebody a loan, you need to know the duration of the loan. You need to know at what point they can pay it back. And sort of by definition, in venture, duration is unknown. We have no idea when we're going to have access to liquidity. And so you can't get debt. But if you are a company, and I'll use us as an example at Carta, where we do have committed regular liquidity, what happens now is employees, even though they have the right to sell at Carta, because they're able to sell, they don't have to, because they can start taking loans against their stock.
Yeah, so I have so many questions, and this is for people who don't know all of the answers. So I'm going to do my best to also define all of the terms as well, because some of these will be new to people.
Sure.
So, kind of the state of how things are now for most early stage founders or employees. They join a startup. They also get equity, and that equity is generally not liquid until they IPO. Liquid meaning they get to use it for anything. It's locked up. And IPO is when a company goes public and their shares are traded on stock exchanges. So for most early stage employees, they can end up having no liquidity for upwards of 5 to 10 years. I wonder why, and then there's the concept of secondary sales, which is the ability to sell shares before a company IPOs. So I guess I would ask a simple question first, which is, why aren't secondaries more common?
Yeah, it's two reasons. So one is there's a bit of a legal challenge where in the public world, because all these the stock and securities are publicly registered, the government basically said that anybody can buy and sell these things, and the company can't put restrictions on that. In the private world, because they're unregistered, not anybody can buy and sell these things, and the company is allowed to put, and it's usually accredited investors that are allowed to buy these, not everybody, but also that the company can put in restrictions preventing these things, from preventing the stock from trading. And I can talk about why the world works that way, but that's the current state of the world. And so there's never been a market that's really developed to allow people to buy and sell private stock, because there's so much friction in that only certain people are allowed to do it. And then also there's all these legal hurdles that you have to get through with the company to allow it to happen.
Yeah, and I remember when we were talking before, there are different ways to even do secondaries. There's like a tender offer, a reverse tender offer. I think there were even other things than that. What do any of those things mean, and how are those relevant?
Sure. Well, the two most common ways, I'll give you two formats. So one is company sanctions liquidity, where the company decides, hey, we're going to do this as an employee benefit, and allow employees to participate in the appreciation of stock and get some liquidity out of it, and then non-company sponsored liquidity. So the company sponsored liquidity, there can be many forms, but the most common and most dominant form is what's called a tender offer. And how these tender offers happen, and there's last year, we do tender offers on behalf of companies. Last year we did $7 billion of secondary volume via tender offers, and the year before was 2 billion, and the year before that was 1. So you're really seeing this massive, growth in tender offers. We do today about one tender offer every business day, 20 or so a month. And that's how most employees today experience liquidity. And how it happens is a company, we usually raise a primary round. So they have a price in the market. The investors have said, we're going to invest $100 million at a $1 billion valuation into the company. But what happens is, if the company only needs $100 million, but let's say there's $150 million of demand, $150 million that investors want to put in, what the company will often do is say, I'll take 100 million onto the balance sheet for the company needs. And that additional 50 million of demand that we have, excess demand, I'll allow employees to sell their shares as secondary into that demand. And that's a tender offer, and that's how that happens. There's another form of liquidity that's less, I would say, a dollar volume is less common, but there's certainly something to address. It's usually for very late stage companies. You don't see this in early, but in later stage companies, there are these sort of peer-to-peer transactions, these marketplaces that aren't company sanctioned, where employees can work with a broker that will try to match a trade, and they can sell shares. It's a bit painful because you have to go to the company to exercise ROFR, or see what the legal rules are. You don't know who's going to buy it on the other side. Pricing tends to be pretty opaque and predatory, but there is that other form of secondary liquidity. Most companies end up doing tender offers in part so that employees don't go into the black. I would call it like the black market of secondary trading, so that the employee can kind of control the price and the experience for employees.
Yeah, if I remember correctly, everything I've read about Carta X seems like it's intended to solve this problem. Is that a fair statement?
Yeah, that's right. And so Carta X is, if tender offers, which we do on Carta X, so tender offers is sort of the purest or the most ubiquitous form of employee liquidity. Carta X attempts to solve, like, what's the next version of employee liquidity, in the market? Because the tender offer it's a good instrument, but it's a relatively crude one, because you can only do it in conjunction really with a primary round, right? Because you already have this excess capital. You only do it in conjunction with the primary round, which might only be every 18 months. You also only do it if you have excess demand. And so what if you wanted to do liquidity, but you don't want to raise a primary? Like, how does a company offer employee liquidity there? What if you're doing liquidity and it's in between a primary? You're doing primaries 18 months apart. You're doing something right in the middle. You shouldn't use the same price you used 9 months ago, because the company is growing. Employees shouldn't sell at a lower price. We should be able to find a good price for them for secondary. And so there's all these kind of questions that come up once you say, well, hey, what if I don't want to just do an excess demand tender offer as attached to a primary, but I still want to provide liquidity? And that's the problem Carta X tries to solve.
Gotcha. Yeah, and I guess I'll ask a tactical question from the founder perspective, which is, in the very early days, you tend to give founders or very early employees restricted shares. And that's pretty straightforward. It's not very complex. When the cost of buying the shares is really low, it's very easy. Then you get to this point where the cost of buying the shares is too high. You switch to ISOs. And then it seems like once you become a public company, you switch to RSUs, which are restricted shares as well. So it seems like there's this trough where you have to be given options. And I assume it's because of the 409A price versus also liquidity of the shares. It feels to me like restricted shares are better for employees, because you're actually giving them the shares, as opposed to saying that you have the right to be able to purchase the shares, because they're not free. You actually have to pay for them. So you only see benefit if they increase in value, as opposed to just getting the value of the shares. So there's a much more speculative component to that. Is that a fair statement?
Yeah, that's fair. The advantage, the reason why the very early employees and the founders get restricted stock is because they buy it. And you may remember when you first incorporated the company, you probably wrote a check for $35 or something like that bought you half the company, because these shares were done at par. And then early employees were came in very, very early, where the price of the stock was just pennies, and you could literally just write the check and just get the shares. That was really advantageous. The problem is, at some point, the price of the stock becomes prohibitive, where you can't just write a check to get the shares. And so that's where options came in, right? Because you could issue the options, and there's no cost to the employee, at least right away. They can have the options, hold the options, and if the company doesn't succeed, it's okay, no harm, no foul. They were never at risk. And if the company exceeds, they can sell the options. And the problem, of course, with options is that at some point you do have to buy them, but it could be when you're public and the strike price is so low relative to the public price, and all of that is great. The reason why when you get into public world, you get into RSUs is because the volatility is much lower, right? When you're a private company and you come in and the company is worth $50 million and you got priced at your option grant is worth $50 million. Really, the bet is not that the company is going to go to $75 million, right? And you're going to get 50% appreciation. It's that it's going to go from 50 to 5 billion, 10x, 100x, and so then the strike price is negligible. It doesn't really matter. But if you're now in the public markets and you're giving out stock options, where the strike price is at, the company's worth 10 billion and 3 years from now it's worth 15 billion, that strike price actually matters a lot because that's most of the value, right, is in the strike price, not in the upside. And so what public companies do to address that is they give restricted stock units, which is effectively stock that with no taxable event. That's why it's restricted stock unit versus restricted stock. It's a right to have the stock versus the actual stock, because if they gave you the stock right away, you'd have a taxable event. So they give you a unit, which represents the stock that you can redeem later. And that means if I give you, $100,000 of RSUs, that's now actually worth 100,000. It's not, it's 100,000 options where the option strike, it's basically worth zero yet, right? Because you still have to wait for the company. And that's how and that's why, if you work for a bigger company, you usually have a lot more guaranteed cash with salary plus RSUs, which is a guaranteed amount. You get the full amount of the stock value. But in options, it's not guaranteed, but it has all the upside.
Yeah, interesting. And so I guess I would ask a tactical question. So we're still pretty early stage. Our most recent round put us at 300 million post in terms of valuation. We're now at the point where the stock is too expensive to be just given, and so we've had a lot of internal conversation about whether we should do these as RSUs or ISOs. What is I've listened to a lot of conversation about it. I still don't feel like I totally understand the trade-offs there. How do you manage it at Carta, and how should early stage companies be thinking about these things?
Sure. Well, so part of it goes to who's the type of person that you're recruiting, and what are you competing against? And at 300 million, most of the type of people you're recruiting are startup people. They want to work for a startup, and you're competing against other startups for these people. And what most people are, they're looking to work for a startup is really looking for the upside. And a big part of the upside, to get that is through the option grant. And so it makes a lot of sense, even though the price of the stock makes it too expensive to do restricted awards. This is perfect for ISOs, and this is exactly what ISOs were designed for. So you are very much in the ISO stage of existence or life cycle. When you get to, maybe it used to be $1 billion, now it's maybe $2 to $5 billion. When you get to, say these days $5 billion in market cap, that's about the time you really need to start thinking about RSUs. In part because it just, it's not like, oh, it's pretty expensive to exercise your stock. It's just like $100,000 for somebody to exercise it. It just doesn't make any sense. But also the type of people that you're recruiting for, it's a different labor market. When you're a $5 billion company, you're not getting startup people that are trying to be one of the first 50 employees, right? That's not the labor market. We're worth, 8 billion, 8.5 billion or so. Many of the people we recruit from, we're competing with public companies. These employees work or used to work for public companies, and they're used to, RSUs, and not like, hey, I'm looking for this 100x upside. I'm like expecting, some of my comp is based on stock, but I'm expecting to accrue, X, $200,000 a year in stock plus a salary. I don't expect to accrue zero, and then maybe 200,000 if it doubles, right? I just expect to get that, and that's what an RSU does. And so that's what we have switched to RSUs, in part because that's the type of financial compensation our employees now are used to.
Gotcha. That's really helpful. So I wonder, circling back on the question of secondary sales, one of the things that I have found talking to a lot of people about how they understand the value of startup equity, they often think of it as a lottery ticket. And it really doesn't mean anything to them until it sort of, at some random point in the future, it can be worth a lot of money. And I found that a lot of companies that I've talked to also use the lack of liquidity as a retention mechanism, which I think is kind of gross, that I want to make sure that we avoid. So I I want to better understand, is it just the complexity of doing secondary sales that prevents people from doing it more often, or like, because we're thinking about doing regular secondary sales maybe twice a year, and we I wonder how it affects things like 409A, which is the strike price, how it affects other things within the company. What are the considerations that we should be thinking about, and why isn't regular secondary sales just the industry default?
Yeah, it's a great question. So I would say there's some real hard, economic and legal reasons that do create friction in secondary markets. But before I go into the details, I will say that some of it's just inertia. Historically, there was like the old investment. If you talk to a venture investor that's over 35 or 40, they will tell you nobody gets liquidity until the investors get liquidity first.
Yeah.
And it's just a mindset that the old generation does. I think newer, GPs under 40, are much more progressive thinking, but I do think there's a little bit of just a cultural mindset to get over. And I think, incredibly thoughtful and progressive CEOs like you will start pushing the ball forward and the world will change. I do think that's a trend. So I think 10 years from now, it will not seem like a weird thing to get liquidity. I think it'll be,
Mm.
I think people 10 years from now will go, can you believe people used to go work for a startup and knew they would get no liquidity until an IPO? That will seem crazy
Yeah.
to the employees 10 years from now. They just won't understand why we did what we did. So I think that's worth noting. But I do think there's a couple of things. You're in a unique position, Sam, because you have an incredible company and you have an ability to raise capital. And you're not worried about it. So one of the reasons that some companies wouldn't want to do secondary is if they feel like this company is not strong enough to be able to raise primary capital, then they would never do secondary because now, any capital that is going into buying stock for this company, they want to put into the company.
Right.
We're
Right.
all, by kind of definition, venture-backed companies, we're not profitable. So we rely on capital markets. We rely on investors. And I don't want to have to compete with my own employees or my shareholders, for access to capital. And so that's why the company always gets the money first. And then if there's excess demand, it bleeds into the secondary market. And so I think one of the things that will shift is that, to your point about for employees, it's a lottery ticket. One of the real challenges for employees is they have to be an investor as well as an employee, right? They have to pick the company that they think is going to win. But the disadvantage that employees have over investors is they only get one bet. Investors can pick a portfolio of
For
companies.
sure.
Employees can only pick one, and they usually have less information than investors do. Like they don't get the financials, they don't get the strategy decks, they don't get access to the management team, and so it is for them somewhat of a lottery. And so, how does an employee know which companies are going to be the best ones? Well, one heuristic or one tell is if a company can regularly do secondaries, that means that this company has access to capital that other companies don't. That this company, the capital markets deem this company worthy of having more investment dollars than the company even needs. And that is not only a great employee benefit, but that is a very powerful signal that this is a strong company.
Gotcha. Yeah, and we're trying to think about the implications of a company at our stage doing, call it, twice a year secondary sales. I was talking to Vinay, who started Loom, and thinking about from the founder side, like, what would be the reasons not to do this? And there are questions around how it impacts 409A and how that reflects the value of ISO shares versus RSUs, and should you switch to those earlier? And what the chances are that the 409A price will converge if you do regular secondary sales. There's also something around the like compensatory implications as it relates to accounting on whether these secondary sales trigger some different accounting mechanism on how those grants are calculated and how that relates to taxes. So I don't know. I assume these are things that you have thought about because I'm kind of new to this, trying to figure it out.
Yeah, sure. So on the 409A, so I have thought a lot about this, and I have this
Yeah.
409A conversation, you know, weekly, if not sometimes daily. And I really need to write a blog post about this so people can read it. So the
Well, you're
409A,
saying it in a podcast now, so
yeah, that's
get
right. So
this.
hopefully everyone will listen to
Yeah.
hear, from the horse's mouth. I'll call it the 409A myth, which is that if I do secondary transactions, my 409A, skyrockets. It's not true. Uh, and the reason it's not true is when they do 409A calculations, um, think of it this way, right? The 409A is the price on the common, and how 409As are calculated is you took at the last major transaction price, usually of financing, and then you say, oh, you discount it for the common stock because it doesn't have all the rates and preferences, and that's your strike price, your 409A price. And then when there's a secondary trade that happens, they have to take into account the volume, the size of the trade. Because let's say just you're a $300 million market cap company, and uh, there was a trade where one share changed hands. An employee sold one share for $10 to somebody else, but it was at a $500 million price. Does that make your company worth $500 million? Well, the accounting rules say no, because it's not a real market, right? One share does not represent a market for these shares. And so the question is, okay, well, what's the size of trading volume that defines it's now a market, and that's the new price is $500 million. The answer is we don't know. So what they do is they basically take a weighted average. So if $10 million of level stock trades out of a $300 million market cap, they effectively adjust the 409A price based on 10 million out of 300 million total market cap. So if you're trading $300 million of liquidity every year, yes, it will converge, but nobody does that. It's usually 2 to 5% of the total market cap that trades on secondary.
Right.
And so the 409A price movement is really nominal. And just to give you a concrete example, we've done 9 liquidity events, and our 409A price is still at about 40% of our preferred. So it's a myth that this stuff affects the 409A. It really doesn't, and we can help with that.
Yeah, that's helpful. And then Zach might actually be able to be more specific around some of the accounting implications, which may be something you've thought about as well.
Yeah, and Zach here. So, in moving forward with our own potential secondary sales, one thing that outside counsel and some of the great folks at Carta have mentioned to us is we needed to chat with an accountant to make sure that if we do regular secondary sales, as opposed to just piggybacking off of a fundraise, we need to be cognizant of how the IRS might look at that. So, for example, would it actually be looked at as us finding a mechanism of compensating our employees, in which case the tax treatment might be different? And I think another key concern that was raised to us is the possibility that for GAAP accounting purposes, we might need liability accounting as a result of regular secondary sales. So it would be wonderful to hear your thoughts on how much of a concern those things are for companies. Is that a real concern? Is it a false concern? How have you seen companies deal with it?
Yeah, absolutely. So that one is a real concern, and there's 2 parts. So one is how do you get capital gains treatment, and then what's the accounting responsibility of the company? If you get into liability accounting. On the capital gains treatment, that if you are running tender offers, that's why you need a certain number of investors to participate in it. Because if you have the tender offer exclusively for employees, uh, uh, it's deemed sort of a company compensatory event. If you include investors in the mix, it's then considered a shareholder event. And the IRS treats if it's just employees, it's compensatory, so they pay income tax on the sale. If you include investors, it's considered shareholder, investment, and you pay long-term capital gains. So whenever we structure on Carta X, transactions, and if we were to help you with it, if you were to do one soon, we would say, hey, here's how you structure. Allow employees to sell, this much, and investors to sell this much, and then we'll make sure we have an appropriate mix so everyone gets those capital gains. On the liability accounting, if the company commits to a schedule of these regular tender offer events in a compensatory fashion, then they now have liability accounting because they're effectively committing to this additional compensation. But as long as they're always doing this with enough investor mix, so it's a shareholder event, not a compensatory event, it won't trigger liability accounting. And that's all the stuff that we can help you with Carta X is how to structure these things so that they make sense.
Great.
Gotcha. That's super helpful. And I guess one of the other things is we're trying to think about the best way for us to structure it. And when we think about how we want to give employees liquidity would be, I think this is what you referred to as a reverse tender, which is allowing people, basically call it twice a year. We ask everyone, we say, you can sell up to 10% of your ownership. How much do you want to sell? And then we come up with however many shares that is. And then we work with Carta to come up with the market for that. Is that a thing?
Yes, absolutely. And everything's sort of exactly right, Sam. I'll throw in one extra piece you need to decide is in a reverse tender, you set the price. So in a tender, the investor sets a price and says, hey, here's the price we want to tender shares at. We're going to go buy at this price. Who's in? In a reverse tender, you decide, hey, we are going to tender, allow employees to sell at a $500 million market cap price tag. We'll then collect all this, and 10% is vested, and all the rules around it, including if investors are allowed to sell as well to get capital gains treatment. We'll aggregate the supply into a block. And so let's say there's, out of a $500 million price tag that you and Zach set, $30 million of supply is now available to be sold. We'll then take that $30 million on Carta X, and then we'll syndicate it, which basically means we sell this block of $30 million of levels stock to investors. And then that's how that transaction happens.
Gotcha. And how does this tie in? I remember seeing some documentation about Carta Cross. How does that tie into like a tender offer or a reverse tender offer?
Yeah, so there's a lot of different types of transactions that you can do in secondary. So obviously tender offer is one, reverse tender offer is another, when you don't have an existing buyer, in a primary where you're going to go sell the block. There's also things like block trades where we may just aggregate a bunch of employees there through interest indications and then pull a block together and then sell it in a peer-to-peer transaction. And then there's a handful more, but the one you're specifically referring to is our auction product, which is what if you want the market to decide the price for you? So in both tender offers, the investor decides. In a reverse tender offer, the company decides. But what if you were to say, look, I want you to create a competitive environment where sellers put in their limit orders. Like we can look at everybody, Bob, wants to sell 100 shares at $10. Mary wants to sell, 50 shares at $11. Everybody can put in their specific price preferences on the seller side. And then on the buyer side, buyers can put in their limit orders. I want to buy $10 million, at $10. I want to buy $5 million at $11.
Oh, cool.
And then we build an order book on both sides. And then we find a clearing price. So the investors are competing. And that's how it's instead of continuous trading, it's a discrete point in time that everybody puts their limit orders, and then we can build the book that way. And then we can decide what the right price is for you and execute at that price. The reason you might do that is if you think, I'm not interested in kind of guessing what the price is. I would like to see competitive dynamics. Now, the trade-off is you are the trade-off is it's higher volatility. You are more likely to get a higher price through a competitive offering in an auction than you would be pre-negotiated, like in a tender. But you also run the risk that maybe there's not enough competition and you actually get a lower price, and that's the risk. And we at Carta, we're at a size and scale now where we've moved to auction models, and so we have enough demand. But in the early days, the book usually isn't thick enough to support an auction. So it's usually something we'd only do for companies, sort of $2 billion and up.
Gotcha. And so I'm wondering, for, call it, top tier VC backed companies that are growing very quickly, what would be reasons? It feels like pretty much every company should do this if they're in that category. No, like what would be the reasons why a company would choose not to allow secondary sales?
I think at this point, there isn't a good reason. I think companies that don't, it's really an inertia issue. Like, well, we just never done it before. Should we do it? I don't think there's a good reason. And I actually think what's starting to happen is that the best companies are doing this, and employees are starting to take notice, and migrating to the companies that offer liquidity. And I think what you're going to start to see is that companies that the best companies are starting to do it. They'll attract the best talent because now the offer is cash, stock options, and liquidity. And that's more attractive than companies that are just cash and stock options. They'll start winning the talent wars, and then everybody else will start to have to follow suit. That's actually going to make it harder for the non-top tier companies. Because if you're a non-top tier company and you're struggling to attract capital, it makes it much harder for you to create liquidity for your employees. And this will actually create a even stronger power law in venture where the best companies will win even bigger.
Yeah, and I wonder from the Carta side, because Carta X looks like it's a platform built for this. And it seems like basically every early stage company uses Carta to manage their equity. How much friction is there from, like, let's say there's a Andreessen backed company, they're at $1 billion valuation. They just decided, all right, we're going to start doing regular secondary sales through Carta X. What's the timeline, and how much effort and how much friction is there to have to do something like that?
It's super it's super easy if all they're doing is a tender offer. So let's say they've already got investors lined up, they have insiders that want to buy it. We don't have to find investors. We can almost I might be slightly oversimplifying, but pretty close. Push a button and they can start running tender offers. It's super easy. If they're in this kind of phase where they're saying, hey, we don't have investors, and I, as CEO, I have to run the business. Like, I don't want to go raise, if I have to raise money for the company, like, that's my job every 18 months, but like, I don't want to keep doing it, every 6 months for liquidity. Can you help us, Carta? And that's our job, is to raise capital for you and not have you have to go do it every single time. So we have a bunch of bankers that do this, and Carta X. Then it usually can take sort of 30 to 45 days, because we'll have to sort of get some basic information. We'll have to talk to investors, sort of pre-market, get some early indications of interest and pricing guidance. And so we'll work through that, but it's a relatively low lift on you. It's us working in the background. But then once we have the syndicate set up, then it can be really quick, right? As soon as if I came back to you, Sam, and I said, hey, we have, X number of, 4 investors that want to buy $20 million of secondary at this price. Is that interesting to you? And you said yes, then we can execute really quickly.
Gotcha. And I wonder, this is, I think, another one of, you mentioned it's more of an inertia thing, but almost every founder that I've talked to says that they wish they took secondary earlier. And I wonder what you think what would be too early to start doing secondary sales for a company? There's probably some lower bound there. What in your mind is the right time for people to start offering this kind of thing?
I think, if you just think in terms of pure market cap, and it changes based on the markets. $500 million market cap today is different than what it meant,
Yeah,
3 years
totally.
ago, 4 years ago. But I would say, we see companies as early as $200 million of market cap starting to do tenders, relatively very small amounts. But I can totally see that starting to happen. I think 500 million is where you start to there's meaningful, liquidity and wealth that's been generated. I think the most important thing from a founder's perspective is, before they go into liquidity, is to say, hey, is my business properly capitalized? Do I have enough capital? And do I have a confidence that if I needed to go raise capital in the future, I can? And I think if those
Yep.
two things are true, I think the company has kind of escaped the early stages that you never know if it's going to work out. But like, hey, we have a real business here. Like, yes, we'll rely on capital markets, but like, we're not going away. Like, we're a real company, and that's
Yep.
a good time to start thinking about it.
Gotcha. That's really helpful. And so I wonder, from the employee's perspective, because this is unusual, most companies don't do it. I'm just trying to imagine from the employee's perspective. Let's say we'll use an arbitrary number, 100,000 ISO options. You haven't exercised them yet. You've been at the company for 2 years, so half of them have vested. And this liquidity, the secondary sale comes about. What is my experience? Is it, let's say hypothetically, the company allows me to sell up to 10,000 shares. What is my experience as an employee going through that?
Yeah. Well, so for most employees, they'll participate in a tender offer. If they were like in an auction, they could actually set the price that they want to sell at. And if it have I want to sell 100 shares at $10, an additional 100 at 11, and they could create very complex trading strategies. But if it's a more simple tender offer, the experience is I have 10,000 options. The offering price is $10. I can sell between nothing and stay long, or I could sell up to 10,000 or 10% of my total stake, 20% of my vested, at $10. And so 10,000 times $10 is $100,000 minus the strike price, and I get that $100,000 minus the strike price back to me. And usually you'll get the whole offering will usually take 20 days. It's a regulatory rule that tender offers have to be open for 20 days. But once that 20 days is closed, you'll have your money, the $100,000 will hit the employee bank account in about 15 minutes.
Interesting. And how does that? I don't know if there's any particular hurdle in the fact that they're options as opposed to shares that you actually own. Does that add any complexity to it, or is it just the strike price just gets subtracted?
It's just the strike price gets subtracted. These are cash settled. So if if the sell price is $10 and your strike price is $1, you automatically get $9. So you would get $90,000 back. So it doesn't matter if it's stock or options.
Interesting. Cool. Well, Zach, I know you had a few other questions as well. I don't know if you had any that you wanted to bring up.
Yeah, and most of my questions have been answered. Just on that last point, and maybe just a clarifying point for listeners. Henry, if I understand it correctly, if you're like an ISO holder, then in order to be eligible for like long-term capital gains, you would actually need to hold the ISO for, let's say, a year. Your vesting period hits, you'd have to exercise and then hold the underlying share for that additional year to be eligible for long-term capital gains. Do I understand that right?
That's correct. Yeah.
Yeah. So the point being, one potential disadvantage of going through a secondary sale process as an ISO holder is that if you went through it, you would actually have short-term capital gains for your sale, which is roughly equivalent to, I guess, ordinary income tax. So just a confusing thing with options, just to flag, is that to really get advantage of the long-term capital gains, you have to check certain holding boxes that include not just holding the option for a period of time, but holding that underlying share for a period of time too, which is sort of a missing piece that it's easy to forget about.
Yeah, that's exactly right. And the IRS, I didn't understand why the rule existed. It just seemed so like arbitrary. The reason is the long-term capital gains treatment is supposed to reward people who take risks. And so by definition, if you just have the option and you do a cash settled option sale, you're not taking any risk because you instantly, you never actually hold a stock. Um, uh, but if you now buy the stock and exercise it, you've now put capital at risk to own the stock. And the IRS says you have to hold it for a certain amount of time for us to give you the benefit of tax, a discounted tax rate for taking on the risk. And it just happens to be for a year. And so what a lot of employees do if they can't exercise their stock is, in my $1 strike price, $10, example, they need $10,000 to exercise 10,000 shares. So what they might do is sell, 1,000 shares to get 10,000 bucks, and then use that to exercise the remaining 9,000, and then hold those 9,000 shares for a year, and then sell those 9,000 shares in the next one.
That's a great insight. Yeah, and Henry, while we're on this topic, what are the sorts of considerations? The process sounds wonderfully straightforward for employees who might participate, but what are the considerations they should have on their minds? What are the kinds of questions they should be bringing to their own accountants before they decide to participate?
So I think one of the things that sneaks up on employees is the AMT. So you should definitely ask it. AMT is, when you think about, let's say my strike price is issued at, $1, and the current value of the stock is $10 for 498 purposes, let's say, or maybe let's call it $5 for 498 purposes. Then when you exercise that, the government treats that $4 difference between 1 and 5 as a gain, and you have to pay taxes on that, which you don't have because it's not liquid. All you did was exercise, but it's a terrible tax rule that we're trying to lobby to get changed. That's the way the world works today. So you should definitely take a look at it. That's why if you are going to exercise options, and I'm a big believer in early exercise. I think it's a great benefit employees can offer, or companies can offer employees. But if you are going to exercise, it's great to exercise when the strike price and the 498 are the same, which is usually when you just receive them. So that's a great thing. The other thing too is if you are having regular liquidity, you now have access to debt that you didn't have before. Silicon Valley is a very strange place. Tech is a strange place. The entire world runs on debt. Like that is, debt markets, are 1,000 times bigger than equity markets. The entire world runs on debt, except for Silicon Valley. We have no idea what to do with debt. We don't know how to loan against, stock. We don't have to give loans to startups. Like none of it. It's all equity based. And the reason why is that in order to give somebody a loan, you need to know the duration of the loan. You need to know at what point they can pay it back. And sort of by definition, in venture, duration is unknown. We have no idea when we're going to have access to liquidity. And so you can't get debt. But if you are a company, and I'll use us as an example at Carta, where we do have committed regular liquidity, what happens now is employees, even though they have the right to sell at Carta, because they're able to sell, they don't have to, because they can start taking loans against their stock. And so one of the great loans that we have is employees can get a loan for a house for the down payment of a house. So let's say an employee at Carta wants to buy a $5 million house. They have to have $1 million down payment. Instead of selling $1 million of Carta stock, they can borrow $1 million collateralized against their Carta stock because the banks are willing to underwrite that because they know that there will be liquidity in the future. And so they don't even have to sell. It's sort of this weird thing. Because you now offer the ability to sell, you now don't have to sell because you have access to so many financial products you didn't have access to. Which is great for me because I love it when employees get liquidity, but I also love when they can stay long. I don't want them to have to trade in this high growth, amazing Carta stock, that we think is going to go to the moon for this, investment that's accruing 3% a year indexed to inflation.
Yeah.
Yeah, that's Henry. That's wonderful. And is that the sort of thing that would be that the employees of any company offering regular secondaries would be eligible for, or What would sort of need to be true for a company to make that happen? I would assume something like it's being obvious that investors are indeed lined up to participate in the secondaries, maybe a certain valuation. Just curious, what needs to be in place for that to be optional for?
Yeah. So one of the wonderful things historically, any loans that are given to employees is an underwriting of the employee. They have to look at the employee. It's just like going to a mortgage. You go apply for a mortgage. And what's great about these stock based loans, loans collateralized with the company's stock, is that you only have to underwrite the company once, and then once you underwrite the company, you can offer the same program to all employees. And so what happens is if you apply for this, you apply as a company, not as an employee, and you say, hey, can we participate in the stock-based loan program? We have our credit partners in the back end, but we do the underwriting. And basically we'll underwrite the company and we'll say, hey, here's what it costs. Here's the loan to value ratio. Employees need, but here's all the terms that goes into it. Is this something you'd like to roll out? And if you say yes, then we can just roll it out to your employees. And it's a combination of both your liquidity, and how much liquidity you do and how much confidence we have that you can keep driving liquidity, but also like, is it a good business and what's your growth rate like? Kind of very traditional underwriting of corporate debt.